We've created digital credit, and we think Bitcoin is digital capital, and we think the killer app of digital capital is digital credit, and Stretch is digital credit. So Bitcoin is a 40 vol, 40 ARR asset, and we have stripped most of the volatility and most of the risk off it, and we extracted about 11% yield with about 3 vol. We think that's the gateway to get to digital money, because if I can strip 40 vol, 40 ARR down to 11% or 11.5% yield and 3 vol, the next step is 0 vol, 8%. And so if you want digital money, the ideal money is like a stable coin or a bank account that pays you 8%.
If you found this helpful, please like, subscribe, and turn on notifications for more insights into the digital asset space. Your support boosts the algorithm and helps this channel grow immensely. Drop your thoughts in the comments below. Thanks for watching and enjoy the rest of the video. Saylor begins by addressing one of the biggest misconceptions among Bitcoin enthusiasts. Many Bitcoiners ask a simple question: why don't people just buy Bitcoin directly? According to Saylor, the answer lies in human psychology and financial reality. Bitcoin is an extremely volatile asset. He describes it as a 40 volatility, 40 annual return roller coaster. While its long-term performance has been extraordinary, most individuals and institutions are not emotionally prepared to withstand dramatic price swings. A young investor with a long-term outlook might comfortably hold Bitcoin for years without touching it. But retirees, corporations, conservative investors, and treasury managers operate differently. They need stability. They need access to capital in the short term. They cannot risk seeing their operating cash decline by 30% or more during a market downturn. Saylor explains that these investors still want returns that beat inflation and outperform traditional money market accounts, but they also want principal protection and lower anxiety. This creates a huge market opportunity. He says that if you walk down the street and ask people whether they would prefer a highly volatile crypto asset, a highly volatile stock, or a bank account-like product paying 11% tax-deferred, most people will choose the third option. This realization became the foundation for Strategy's new financial products.
And the most important point is, the Bitcoiners go, why don't you just buy Bitcoin? And the answer is, if you want to get on a 40 vol, 40 ARR roller coaster and hold the money for 4 years and not touch it, you should buy Bitcoin. But only a small percentage of people, have the conviction to do that. The people buying Stretch are retirees. 65-year-old guy wants to live off of his retirement income. If, they're conservative investors, they're corporate treasurers. Like, I need the money back in 6 months to pay taxes. I need the money in a year to pay my kids' tuition. I want to get paid double or triple or quadruple a money market, but I don't want to risk my principal. So if you think about people that need, they need principal protection, and they want to compound their wealth in a low risk, low anxiety way. They want to preserve their wealth while they compound it faster than inflation. That's a lot of people. And so, Stretch represents a bank account that pays you 11.5%. And if you walk down the street and you say to people, do you want to buy a highly volatile equity? Do you want to buy a highly volatile crypto asset? Or do you want a bank account that pays you 11% that you don't have to pay tax on for the next decade? You do the poll, it's not complicated. There's a lot of people that will say no to the first two, and they'll say yes to the third. But here's one more point. Even the people that would say yes to the first or the second, like if you're willing to bet half of your net worth on Bitcoin or half of your net worth on Nvidia, you still have money that you need to pay the mortgage, taxes, your kids' tuition, or you have working capital in your corporation. And that working capital is what I'll call short duration capital. You need it back in the next 3 years, and you can't afford for it to be worth 30% less on a drawdown. And so everyone has working capital, and digital credit is a really good fit for working capital needs of people in the crypto economy. And then it's really expanded the entire universe, because it's drawn in all of these non-crypto investors, non-Bitcoin investors, non-vol investors. Scott, like, I've gone and I've pitched Bitcoin to corporations. It takes you hours and hours. You got to go to the board of directors and spend an hour or 2 hours in front of the board of directors. You have to convince the CFO, the treasurer, every member of the board of directors. And if one member of the board of directors goes, oh,
You're done.
I'm not sure, okay, we'll wait for you. On the other hand, if you go to a corporate treasurer or CFO and say, hey, I have something that yields 11.5% tax deferred. Do you want to put 5 or 10% of your working capital into this instead of holding it in money markets? Well, we've created digital credit, and we think Bitcoin is digital capital, and we think the killer app of digital capital is digital credit, and Stretch is digital credit. So Bitcoin is a 40 vol, 40 ARR asset, and we have stripped most of the volatility and most of the risk off it, and we extracted about 11% yield with about 3 vol. We think that's the gateway to get to digital money, because if I can strip 40 vol, 40 ARR down to 11% or 11.5% yield and 3 vol, the next step is 0 vol, 8%. And so if you want digital money, the ideal money is like a stable coin or a bank account that pays you 8%. And right now, people are developing those yield coins, 0 vol, 8% money, and they're doing it with digital credit. So I'll be speaking about how we created digital credit, which has exploded. It's gone 0 to $8.5 billion in 8 months, and it's growing 350% a year. So I'll speak about that phenomenon. I'll talk about why that is spreading through the TradFi ecosystem. And then I'm going to talk a bit about digital money and digital yield, how you can take stable coins and DeFi protocols and loop that credit 3x, 5x. So you either get a stable coin or a yield coin that pays 8%, or maybe you create a 25% 3x levered or looped digital yield token or digital yield fund. And so I think what's fun right now is digital credit is bringing the capital gains and the power of Bitcoin to the crypto and the digital assets ecosystem in the form of yield coins and DeFi. And we're seeing the two hemispheres of the industry, crypto and Bitcoin, come together. So instead of having capital and crypto that never finds Bitcoin, and capital and Bitcoin that never goes into DeFi or crypto industry, now the capital flows in, it flows to yield coins, it flows to digital credit, it flows to Bitcoin, it loops back, and it invigorates the entire industry. Yeah, and the issue is it's very difficult to go from 40 vol to 0 vol. Like that's a massive, massive shift. How do you strip all of the volatility off of Bitcoin and get to perfectly pegged to the dollar and extract a yield? What we discovered is you need that intermediate step, and the intermediate step is digital credit. So the idea behind Stretch or digital credit is you're converting a capital gain into a dividend, a credit dividend. So if I expect 30% returns on Bitcoin capital, I can just strip the first 11% and pay it as a credit dividend. So the way we created Stretch is we created a preferred stock that's a monthly variable rate preferred, and we pay like 11.5% right now. And the way we fund that dividend is through investing in Bitcoin and then capturing a portion of the Bitcoin capital gain, monetizing it. And so the first step to creating digital money and yield coins and putting yield into the DeFi ecosystem, which powers it. It's like electricity jacked into DeFi. The first step is create digital credit. And we were uniquely able to do it because we inadvertently built a $50 billion equity stack when we built Strategy. And so we have about an $85 billion enterprise value now. We've got about $58 billion of equity. And for every dollar of equity, you can maybe sell 20 cents of credit. You want to be 5x over collateralized. So we took our Bitcoin and everybody said, well, what are you going to do with the Bitcoin? How do you generate yield on the Bitcoin? And we thought, well, we're going to actually sell the credit to generate the yield. So we discovered Stretch, we created it, it exploded. It started growing 300 to 400% a year. In the month of March, we sold about $1.5 billion of it. And in the month of April, we sold $3.2 billion of it. So, multiply 3.2 times 12, and it's a horrendous, incredible, terrific run rate. So that was the first step, taking digital capital, making it digital credit. And people think, well, you're crazy to pay 11.5% dividend yield. But the point is, it's a perpetual swap. We're basically swapping you SOFR plus a credit spread forever, and we're getting back Bitcoin return forever. And that's very different than a bond that's never coming due. And the company has the option to lower the dividend if SOFR falls. And the company has the option to compress the credit spread over time as people get more comfortable. If Bitcoin rallies, if they like the business model, as Bitcoin gets more institutionally adopted, as the credit rating agencies start to embrace digital assets and the banks embrace digital assets.
Saylor explains that for years, Bitcoin and the broader crypto industry operated separately. Bitcoin investors focused on long-term capital appreciation. DeFi investors focused on yield generation and token ecosystems, but digital credit is now merging these worlds together. Capital now flows from Bitcoin into digital credit, into DeFi yield systems, into stablecoins, and back into Bitcoin. This interconnected flow strengthens the entire ecosystem. Saylor describes yield as the electricity powering decentralized finance. By introducing Bitcoin-backed yield opportunities, he believes DeFi can evolve far beyond speculative trading into a mature financial system.
We expect the credit spreads to come down, and so that's how we create digital credit. We were fortunate enough to have a massive set of equity investors that support our stock. We trade billions of dollars in equity every day. We're lucky enough to have a bunch of TradFi derivatives traders. We have about $40 billion of open interest in the options market. And yesterday, if you were watching CNBC, at the end of the day, they said the number one biggest options trade in the entire United States today is strategy. Some options trader is laying on a multi-$100 million options bet, which surprised me. So the point is, we have options traders, derivatives traders that are supporting us. We have equity traders supporting us. We went into Stretch with a bunch of hedge funds, and then the hedge funds started arbing Stretch. And Stretch became the biggest preferred stock in the world. And then it became the most liquid preferred stock in the world. And that all happened in about 8 months. So Stretch exploded to be about $350 to $400 million of liquidity a day. And here's the cool news, Scott. We didn't really understand the DeFi space, and we weren't heavily steeped in stable coins and DeFi and crypto. We were always focused upon Bitcoin and TradFi. But a bunch of digital assets innovators like Apex and Saturn and Pendle, they all started thinking about this, and they built yield coins, and they built tokens that were backed by Stretch that generated yield. Because from their point of view, they're saying, am I going to power yield with a real world asset like a T-bill, which pays you 3.5%? Or am I going to power my yield with digital credit that pays 11.5%? So in essence, we're offering 11.5% yield into the DeFi space as the starting point, and it's exogenous. It's basically backed by our 80 billion, 58 billion of equity or $85 billion enterprise value in our Bitcoin stack, which right now is almost 4% of the Bitcoin supply. So that becomes a competitor to, other forms of yield in DeFi. They started building that, and that entire complex went from $0 to $300 million in a matter of weeks.
Yeah, weeks.
It's just doing this, and there's going to be 1,000 interesting things to do there. I can't, and it's very creative, and it's very forward-thinking and progressive, and they move about 20 times faster than TradFi. I'm famous for this quote, never sell you Bitcoin. And I think the first year or 2 years, the way that we grew this business is we would fund the credit dividends by selling our common equity. Well, what we're really doing is we're funding credit dividends by selling a Bitcoin derivative.
Right.
MSTR. But to a casual observer or a skeptic, or a troll, they would say, well, you're just you're paying the dividends of one type of equity with another type of equity, and they don't like that. So I think it's very important that we break that cycle and illustrate what we're really doing is we're selling a credit instrument to buy a capital asset. We're selling credit to buy capital. The capital asset is Bitcoin. It's like you're selling credit to buy real estate. The real estate appreciates. You sell the appreciated real estate to pay off the credit dividends.
Tale as old as time. That's what I was going to say. I mean, that's a proven strategy to accumulate wealth. Right?
You could boil it down to capital gains fund credit dividends. If you think about the theory of asset-backed credit, if you think that the capital investment is going to appreciate at 10% a year, you can pay a dividend of 5%. If you think the capital investment is going to appreciate 20% a year, you can pay a dividend of 10%. If you think that real estate's going up 7% a year, you can pay a dividend of 3 or 4 or 5. We think Bitcoin's going up 30% a year. We have no problem paying a dividend of 11.
But you don't need it to.
We don't need it to. We're so over collateralized that the way it works out is if it goes up 30%, you know, when we sell $1 billion of STRC, if Bitcoin goes up, you know, 11%, we'd make $1 billion in net income, that our Bitcoin gain. If it goes up 22%, we'd make double that. We'd make $2 billion, $1 billion up front and $1 billion over time. If it went up 30%, we'd make $1 billion up front and $2 billion on the back end. It's screamingly profitable for the equity investors. But on the other hand, if all Bitcoin has to do is go up our break-even level, which is 2.3%, for us to pay the dividends forever. So we
and
really,
that's on average. That doesn't mean you can't have a down year.
Yeah, on average over forever,
right?
We need 2.3%, and if we don't get that, if we get 0%, we have about 50 years, 40 to 50 years to figure it out. So people, you know, the knee-jerk reaction is, oh, well, they borrowed money at 11.5%, but what they don't understand is that no, we're never giving the money back. We sold equity. And so we sold equity at a variable credit spread over a long period of time. We really just need Bitcoin to go up 2.3% to create value for the common equity. And if it goes up, if you believe that Bitcoin's as good as the S&P, this is a no-brainer to do it. And if you believe that Bitcoin's better than the S&P, this creates massively amplified Bitcoin returns for the equity investor. So we found an extremely low risk, almost, or, you know, I'm not going to say risk-free because the lawyers go nuts, but it's excessively low-risk way to swap the standard overnight funds rate for the Bitcoin return. And, you know, even the U.S. government, you know, they get the standard overnight funds rate, but they have to pay the money back. We're saying we're going to give you the standard overnight funds rate, and we're not going to pay the money back, but we'll give you a credit spread. We'll give you a premium, and that makes it very interesting for a credit investor. But if you're a Bitcoin investor and you want to buy a lot of Bitcoin and hold it for 100 years, hold it forever, then this is the way to do that most intelligently and most aggressively.
Toward the end of the discussion, Saylor returns to his core belief: Bitcoin is the superior long-term asset. He argues that Strategy's entire system only requires Bitcoin to appreciate modestly over time in order to remain sustainable. According to his explanation, if Bitcoin rises significantly, the equity investors benefit enormously. If Bitcoin performs similarly to major stock indices, the strategy still works. Even relatively low average appreciation rates can sustain the credit structure. Saylor stresses that the company is not attempting to trade Bitcoin or generate short-term yield directly from Bitcoin holdings. Instead, the strategy revolves around holding Bitcoin long-term, selling credit products, using appreciation over time, and creating sustainable financial infrastructure around digital capital. He repeatedly emphasizes his famous philosophy: never sell your Bitcoin.